Welcome back, everyone, and thank you once again for joining me here on the Daily Crypto Roundup. Over the last 24 hours, we've seen a fascinating blend of resilience, weakness, and ambition shaping the crypto markets. Bitcoin is holding its ground, Ethereum continues to lag, XRP is showing rare strength, and two big stories are making waves. Tether aiming for a $500 billion valuation, and Morgan Stanley preparing to bring crypto trading to millions of everyday investors through E-Trade. On top of that, the SEC has rewritten the rulebook on how fast ETFs can launch. Analysts are weighing in on what's next, and retail sentiment continues to clash with institutional flows. So today, let's unpack it all in full detail and explore what it means for the next leg of this market. Let's begin, as always, with the top 10 coins by market cap, excluding the stable coins. Bitcoin is steady at around $113,800, up modestly after shrugging off a wave of liquidations earlier in the week. Ethereum is still struggling to impress, stuck just above $4,200 and down on the week compared to its peers. XRP continues to be one of the standout performers, holding at $2.88 and refusing to buckle under broader market pressure. Solana is changing hands around $170, off its highs but still one of the most talked about assets in the ETF rumor mill. Cardano is sitting near 52 cents, fighting to hold that crucial half-dollar line. Dogecoin is holding steady near 25 cents, now trading in the wake of its brand new US ETF launch. Avalanche is near $32, Toncoin just over $6.40, Tron is around 13 cents, and Shiba Inu is flat but maintaining its massive community footprint. Put together, the top 10 reflect a market that's in balance. Bitcoin strong, Ethereum hesitant, and XRP and Solana stealing more of the spotlight. Now let's pivot to the biggest regulatory news of the week, because it's shaping how institutions approach this market. The US Securities and Exchange Commission has just slashed approval timelines for crypto ETFs. Under the new system, funds that meet certain criteria will clear in just 75 days, compared to the months of uncertainty we've seen before. More importantly, the Commission is eliminating the need for individual case-by-case approvals on every filing. That might sound procedural, but it's a structural shift. What it means is that we're about to see a flood of new ETF applications, not just for Bitcoin, but for Solana, Cardano, XRP, and others. Grayscale has already rolled out a multi-asset ETF covering Bitcoin, Ethereum, Solana, XRP, and Cardano, showing how fast issuers are moving to capitalize on the new framework. For retail investors, it means choice. For institutions, it means liquidity. And for the market overall, it means exposure is about to widen dramatically. But regulation isn't the only driver of this market. Let's turn to the story that had everyone talking yesterday. Tether's $500 billion ambition. Reports indicate that Tether is aiming to raise between $15 and $20 billion in new capital, a move that would catapult its valuation to $500 billion. To put that into perspective, that would make Tether one of the most valuable financial companies in the world, larger than many of the biggest banks. Remember, Tether isn't just another token, it's the plumbing of crypto. With over $120 billion in USDT already circulating, it's the unit of account for traders, the bridge between exchanges, and the bedrock of DeFi liquidity pools. Bulls argue that a successful raise of this size would entrench Tether as the irreplaceable settlement layer of crypto. Critics warn that it raises the stakes. If Tether ever faced reserve or transparency issues at that scale, the fallout could ripple through the entire ecosystem. But either way, it underlines just how central stablecoins have become. Next, let's talk about Morgan Stanley and E-Trade, because this is a bridge between two worlds that shouldn't be underestimated. Morgan Stanley has announced that in early 2026, E-Trade will allow millions of retail customers to buy and sell Bitcoin, Ethereum, and Solana directly in their brokerage accounts, thanks to a partnership with Zero Hash. No new wallets, no third-party exchanges, no friction. For millions of everyday investors, it means that crypto sits right next to their stocks and ETFs on the same screen. Analysts say this is about trust and access. Trust, because when a Wall Street brand like Morgan Stanley integrates crypto, it signals permanence. Access, because once it's there, the barrier to entry is gone. You don't need to convince someone to download a new app or send funds to a new platform. It's right where they already trade Apple or Tesla. For years, we've talked about mass adoption. Moves like this show what mass adoption looks like in practice. While those institutional stories dominate, the core market action remains the heartbeat of crypto. Analysts like Mikkel Mork of ARK36 argue that the recent $1.5 billion liquidation wave wasn't just carnage, it was a cleansing. He says flushing out over-leveraged positions creates a healthier foundation for rallies. Edward Moya of Oanda is taking a more cautious tone, warning that investors are rotating out of weaker altcoins and back into Bitcoin, using the ETF inflows as a safe haven. Meanwhile, Matthew Dixon has been highlighting XRP's unusual resilience, calling $2.70 the line to watch. If XRP holds there and pushes through $3 and $3.20, he argues it could trigger what's known as a fifth wave rally, the kind of technical pattern that carries momentum much further than most traders expect. Now let's zoom out for a moment. The crypto ecosystem is at an inflection point. On one side, you have regulation catching up, the SEC rewriting its approval playbook, the US and UK launching joint task forces, Europe already moving forward with MyCA. On the other side, you have Wall Street banks like Morgan Stanley bringing crypto directly to retail users, and stablecoin giants like Tether raising capital on a scale that rivals sovereign funds. This isn't the fringes anymore. This is mainstream financial infrastructure evolving in real time. And in between, you have retail traders, some battered by liquidations, others stacking XRP, Doge, or Sol, waiting for the next breakout. So where does that leave us? First, watch Bitcoin's line in the sand, 112 to 113,000. Hold it, and we could see a push back toward 120,000. Lose it, and liquidations could accelerate. Second, monitor Ethereum's sluggishness. At 4,200, it's not keeping up with Bitcoin or XRP, and analysts are starting to question its near-term momentum. Third, keep an eye on XRP. Its ability to rise when others fall is unusual, and that divergence often signals bigger moves ahead. Fourth, track the progress of ETF flows. Billions are still pouring into Bitcoin ETFs, but the real story is what happens when Solana, Cardano, or even Dogecoin funds start trading under the SEC's new streamlined process. And fifth, keep your eye on the macro. The Federal Reserve is cutting rates, liquidity is rising, and risk assets are responding. For crypto, that usually means upside. But it also means volatility. When institutions smell opportunity, they rotate fast, and that creates the kind of violent shakeouts we've just lived through. Drop your thoughts in the comments. Which story do you think moves the market fastest? Smash like if you're bullish on where crypto is headed. Hit follow so you don't miss the next update. And as always, we will see you at the top.